right, more market chatter now with Andrew Holland, the CEO of Avendus Capital Strategies. Hi, Andrew. Always a pleasure chatting with you. Thanks for joining us here on Markets at Lunch. I know you're a Man U fan. I'm not going to ask you about that sudden exit of the manager, but I couldn't resist mentioning it. Having said that, look what the FOMC has said, the reaction you've seen in the Asian equity markets, and I want to get a sense from you on what's it going to mean for Dalal Street. 2018, a volatile year, a year you've seen FIIs press the sell button. We're going into election year as well, and with the kind of rate hike guidance and the recovery you're seeing in the US, what's it going to be like in 2019, you would imagine?
I think it's going to be well, I suppose it's going to be kind of still volatile in the first few months because, you know, we're going to have to wait and see how the US and China get on with their trade negotiations. So obviously that's going to play a big, going to have a big impact on the global economy one way or the other. And that's why, you know, markets will remain volatile there. But I think the real problem is, and this is something which I've mentioned before to you, is that, you know, the US anyway was late cycle. They've increased rates again yesterday. So the question mark is whether the Fed has gone a little bit too far in terms of interest rate hikes. And don't forget that corporate America is sitting on, you know, $3 trillion of triple-B debt in terms of corporate bonds. So, you know, it doesn't take a lot for that to change and for markets to be spooked. But what I would say is that, you know, whilst we keep talking about the US market and the falls recently from the highs, you know, remember it has been from the highs. It's not as though the market's kind of massively down for the year. That's all been emerging markets. So I think that 2019 is going to be a problem for developed markets, in my view. I think emerging markets will do better, but it will get dragged down along with global markets. But that's where the opportunity is going to lie. So I think there's going to, you know, many opportunities are going to present themselves to get quality stocks at very good prices. So I'm looking more optimistically about the volatility and developed market falls going forward rather than negatively.
When you say quality stocks, so Andrew, when you say quality stocks at this time of volatility, would that also mean that you're hinting at the fact that maybe because of the volatility, is the blue chips that are going to be available at attractive valuations? Is that your strategy?
Yeah, I mean that's what happened in September, October. Quite a number of the, you know, the really kind of the classic blue chips got beaten up for you know too much. Because you had both, you know, domestic selling, but, you know, more concentrated foreign selling, and that threw up some great opportunities to pick up stocks. And you know, all these stocks have kind of recently rallied, you know, from those lows. So that's the kind of opportunities you're going to get over the next 3 to 6 months, you know, in India because of global factors. I'm sure we'll have some of our own, but, you know, why, you know, in the very short term, here's why I'm optimistic about India. And I'm just reversing where we were in August. You have an oil price under 60. You have a new RBI governor who's more dovish than the previous one, who's providing liquidity. So bond yields are probably going to, you know, very quickly going to head towards 7.1%. So the whole banking sector is going to, you know, breathe very easily at night. Liquidity is going to be abundant, and so we go back to if the government can push. And I'm not talking about you know, populist measures, but if they can push the kind of spending in the rural economy as well, on top of their infrastructure spending, then you have a very good kind of run in terms of you know, corporate earnings over the next 6 months as well. So that's the kind of you know, kind of picture I'm looking at the moment, which is a lot more bullish than I have been, as you know, for some time.
Okay, so that's the strategy. But, you know, the other point, Andrew, is that you can never really have a full-on bull rally without the small caps or the mid caps. So while you may get opportunities for these classic blue chips, should one just stay away from the small caps, from the broader universe at this juncture, thanks to all of the uncertainty?
You know, listen, our funds, as you know, only invest in the top 200 stocks. So obviously we're not looking at mid caps and small caps. But you know, if you're talking about the domestic economy growing at 7.5%, the capex cycle will probably, the private capex cycle, if there's no you know, kind of problems with in the elections of, you know, someone having a clear mandate, then you'll see the private capex pick up in the second half of the year. So, you know, for the small and mid-cap companies, now that, you know, interest rates have fallen, I think they'll be able to, you know, see that their margins will improve, and it's a domestic-driven economy, so you'll have that operational gearing as well. So again, selectively, you'd have to look at these, you know, you know, small and mid-cap companies. But you know, I think because of the volatility in the next few, you know, in the next 2 to 3 months, you know, you're probably going to feel a little bit more pain there before things get better. So, and that's why I'm really kind of saying that, you know, the big companies will prove to you know, to give you opportunities, and they'll be the first to move. It won't be the mid and small caps.
Say that, you know, 2019 is also going to be the year for the equities. The reason I'm asking is that you got the real estate market still in the doldrums. A lot of action in the commodity markets, which now seems to be heading down south. And look at the forex markets too. Would that make equities maybe the best opportunity and the best asset class?
Well, you know, if I look across asset classes around the world, I don't think any asset class has really outperformed, to be honest. Maybe bonds at the margin. So, you know, I think it's been a year where most asset classes have disappointed for you. So I think just saying it's equities is the you know, the only place to be. It's not worked out in virtually most of the countries around the world. So I'm not sure that's you know, really kind of lays itself you know, for the same strategy. What I would say for India is, you know, with the onset of lower interest rates, then corporate earnings, you know, will improve, and you'll have this kind of nice run in the next few months. But then we'll get, you know, hostage back to developed markets. I'm afraid developed markets is where I do feel more negative. The earnings growth will start to slow in the US as wages increase, or they have been increasing. Interest rates will take more of your profits away. So there's going to be some big downgrades in the US, and you know, obviously in the UK we've got this mess with Brexit, you know, still going on, and that's going to impact sentiment at some point. So the only good news from the UK was obviously a new manager at Manchester United, which you mentioned, and that's the only positive I can think about the UK at the moment.
You know, no asset class has outperformed. You know, I think a year ago, exactly a year ago, we were talking about the Bitcoin phenomenon. All of those who invested are now, you know, crying quite loud. Look what has happened to the Bitcoin prices. And of course, the Indian government continues to say it is illegal. Now, Andrew, let's get sector specific. You've given that you like blue chips, and blue chips should score over the broader universe. Having said that, within the blue chips, any one particular story that really stands out? You know, a year ago we were talking about private banks. Look what's happened to private banks. A lot of the fund managers now talk about consumption, but then is it the consumption stock story, and the consumption stocks quite expensive now?
You see, you know, we, along with many people, you know, at the beginning of the year, we've always said we like private banks. We've always said we like FMCG, and nothing's gone away from us changing our view there. If anything, I'm more bullish on the FMCG stocks than I have been throughout the period of recommending them. So I think the growth story there just continues to be compelling, and despite the ratings, I really just feel it's an area you have to be over the next, you know, not just 1 year but 3 years you know, to see the kind of full appreciation in terms of the share prices over the next period. The one area that we've been thinking about more and more, and I'm not saying that we've deployed or done anything about it, is obviously with lower interest rates, you know, PSU banks come into the fold, and I think you know, that will help them in terms of their you know, at least their bond gains, or rather than losses. So maybe, you know, we're getting towards the end of the balance sheet problem for the banking sector. So, you know, PSU banks might look more attractive going into 2019. I think, if I'm correct, on the capex cycle kicking off in the second half of 2019, that's a private capex cycle, then obviously industrials, capital goods companies are going to be the beneficiaries. Unfortunately, there's only a few of the large caps there to play on, but I think that could be a new theme for 2019.
Right, Andrew, always a pleasure chatting with you. Thanks so much for joining us on this Thursday's edition of
Thank you.
Markets at Lunch. I look forward to many more conversations with you in the new year as well.